Welcome to The Explainer. All right, today we are diving deep into one of the wildest stories in the software world right now, Figma. It was the high-flying darling of the IPO market, but since then, its stock has been on an absolute roller coaster and investors are trapped right in the middle.
You've probably seen the headlines. The stock is down a massive 80% from its peak. And that leads to the one question everyone is asking. Is this a generational chance to buy a market leader on the cheap, or is this just a classic value trap? A falling knife with a lot more pain on the way.
I mean, to really let the scale of this sink in, just look at these numbers. After its IPO, the stock went ballistic, rocketing up to over $142 a share. Fast forward to today, and it's hovering around $26. Billions of dollars in value. Just gone. So let's unpack exactly how we got here.
So what's actually behind this constant punishing downward pressure? Well, it's not just one thing. The bear case here is really built on three major forces that have come together to create a perfect storm for the stock.
First up is a purely mechanical problem. It's all about these IPO lockup expirations. Think of it like this. Every few months, a floodgate opens, and a whole new wave of shares held by insiders can finally hit the market. And every single time this happens, it threatens to flood the market with sellers, putting more and more pressure on the price. And as you can see, we're not done yet. There are still major expirations on the horizon.
Second, there's a huge shift going on in the broader market. Big money is rotating out of software-as-a-service stocks and pouring it all into AI infrastructure. But there's a much deeper, almost existential fear here, and people are calling it the AI Armageddon. It's this belief that generative AI could just, make tools like Figma totally obsolete.
And what's adding fuel to that fire? Heavy insider selling. We're talking about 5.5 million shares sold by insiders in just the last quarter alone. That's over $209 million. Now sure, a lot of these sales are planned way in advance, but let's be honest, the optics are just terrible. When you see executives cashing out while the stock is hitting new lows, it's gonna spook people.
And of course, this negative feeling gets amplified by big voices in the financial media, who are on TV basically telling people to run away from the entire design software space. That kind of high-profile negativity creates real selling pressure. So you can see, the bear case is powerful, and it's driven by some very real, very tangible concerns.
But okay, that is only one side of the coin. Let's flip it over and look at the bull case. Because if you can force yourself to just ignore the messy stock chart for a second and look at the actual business, a completely different picture emerges. You find a company that isn't just surviving, it's absolutely thriving.
Let's start with growth. How about this? In its latest quarter, Figma grew revenue by a stunning 38% year over year. In today's tough economic environment, that kind of growth is just incredible. It shows you that demand for their platform is not slowing down.
And this next number might be even more impressive. Its net dollar retention is an elite 131%. So what on earth does that mean? It's simple. It means Figma's existing customers are not only staying, but they're spending 31% more money this year than they did last year. That is the sign of an incredibly sticky product that's becoming essential to its users.
And all these powerful numbers have pushed the company past a massive milestone for any software business. It's now on a run rate of over $1 billion in annual revenue. That puts Figma in a very, very exclusive club.
This here really illustrates its commanding position in the market. Figma has, for all intents and purposes, won the war in the UI/UX design space. Its main competitor from Adobe, it's now in maintenance mode, which is corporate speak for "we've given up." Adobe isn't even developing new features for it anymore. This leaves Figma as the undisputed king of the hill.
So what about that AI Armageddon fear we talked about? Well, instead of running from AI, Figma is pivoting to orchestrate it. They're not a victim, they're becoming the conductor. They're launching new AI tools and, here's the kicker, they're going to start charging for them based on usage. This could be a massive new revenue stream for them starting in 2026.
Okay, so this brings us right to the heart of the conflict for any investor. You've got this powerful, scary bear narrative clashing with a story of stellar business performance. So, the billion-dollar question is, at today's price, is this stock a bargain, or is it still way too expensive?
Well, from one angle, you could argue it's still expensive. If you look at its price-to-sales ratio, Figma is trading at a multiple of almost 14. As you can see, that's a huge premium compared to its rival Adobe, and it's basically double the average of its peers. The bears will tell you that premium is just not justified given all the risks.
And if you look at it through a more conservative, old-school lens like a discounted cash flow model, well, you get a similar story. This model tries to figure out a company's value today based on all the cash it's expected to make in the future. And based on that, Figma's fair value is somewhere around $19.70 a share, which would suggest the stock is still overvalued.
But then you have the complete other side of the spectrum. You have the Wall Street analysts who actually cover the company for a living, and their average price target? Over $52 a share. That implies the stock could nearly double from where it is right now. And this massive gap, this chasm between the conservative models and the bullish analysts, that is the absolute core of the debate.
So how do you weigh these completely conflicting signals? What's the right move? Is Figma a buy, a sell, or do you just stay away? We've looked at the bears, the bulls, and the numbers. Now let's try to put it all together.
This slide really is the final scorecard, isn't it? It summarizes the whole conflict perfectly. In one corner, you've got the bull case, a best-in-class business with unbelievable growth, a dominant grip on its market, and a new AI catalyst. And in the other corner, you have the bear case, a hostile market, a scary narrative about AI, and all this pressure from insider selling.
So here's the verdict. Is the business a sinking boat? Absolutely not. Based on the data, the business is a speedboat. It's healthy and it's growing incredibly fast. The stock, however, is a totally different story. The stock is a high-risk but potentially high-reward play. It's for long-term investors who believe the market has totally overreacted to the AI fears and who have the stomach to handle a lot more volatility, especially with another lockup coming in March.
Ultimately, the entire investment thesis really just boils down to this one single high-stakes question. Figma is betting the house that it can be the central platform that orchestrates the entire AI design revolution. The market, right now, is betting that AI will make Figma obsolete. The future of this stock hangs entirely on who is right, and that's the question you have to answer for yourself.